moving forward, there are some questions that we'd like to ask. From history, financial inclusion, has been defined by different statistics. Sometimes when you look at some material, they tell you number of borrowers, number of loans given out, the average size of the loan, the smaller it is, the better, and so on. The lower cost of transactions and so on. So we'll be coming back to these questions. But I would like to take a few minutes to tell you about the history of development finance or financial inclusion or impact financing, which I believe are all the same thing using different words. So in the 1950s, right after the World War II, so some development agencies and some countries wanted to support developing countries to fast-track the poverty reduction process. So there were large transfer of funds to some of these countries, including especially to Sub-Saharan Africa and to Latin America. And this process did not work, obviously due to use of the money for different purposes than what it was meant for. Then subsequently, in the early 1960s and early 1970s was the emergence of NGOs. So if you check the records, you realize that during this period there were a lot of NGOs that were opened. You started working, NGOs, financial NGOs, and their aim was to solve the problem that the first approach couldn't solve, right? So, and then in the 1970s was the financial service sector regulation. So what was happening during this period was the financial service sector regulators were more or less forcing banks and financial institutions to do certain things or to serve specific sectors so that they can be included. Because almost all banks at the time were doing pure commercial banking, focusing on established entities and so on. So we're talking about allocation to target groups, sector allocation, special institutions, and so on. Sometimes interest rate caps, especially in French parts of Africa. And then in the 1980s to 1990s was what we call the institution building. So those of you who have followed the story, you know about institutions like Finca, Opportunity International, ProCredit, where I worked for so many years, Action, Grameen, and so on. And these international financial institutions mostly started in parts of Africa, but largely in Eastern Europe and Latin America. And most of them started by doing what we call the downscaling. So they would identify a large financial institution, a bank, and then they would create the microfinance department or division of the bank. So that's how it started. And then over time, most of these multinationals started building their own financial institutions. So if you follow the history, you realize in the early 80s, 90s, some of these institutions started coming to Ghana. In Ghana, most of them came here around the mid-90s. And then, after some time, was the emergence of local microfinance institutions. So at some point, so the locals thought that they could do it themselves. So regulators came up with rules, and microfinance laws, regulations came up. And I'm sure we all know about the story of the Nigerian market. We know about Algeria and so on, and recently in Ghana. Most of them were implemented wrongly, and there were very serious challenges. And whilst we are still trying to fix these, now we have the emergence of technology, which is what the definition of financial inclusion unfortunately is now. So whenever you mention financial inclusion, everybody is thinking about, how many mobile payments can I make, and how can I do it at the remotest location and so on. But obviously, it's bigger than that. Now, very quickly, I would like to look at a few statistics. So measuring financial inclusion in recent times by the World Bank, looking at high-income countries is more than 80% of people holding bank accounts. That's the average. And then you look at sub-Saharan Africa, that's just around 20%, 22% thereabout. Okay, and the biggest reason why people have not opened accounts, okay, which accounts for about 30%, is that they don't have money, which is my point. So the recent discussion about financial inclusion, it's actually punishing people for being included, because if you do one transaction, you are charged 1%. You are charged 1% for doing the transaction, but you don't have the money. So most people would rather not be included. So it is my view that financial inclusion should make these transactions very cheap and should help people to get things that they would otherwise not get, like insurance, health insurance, and so on, rather than simply charging them. And anytime I speak to the fintechs, most of who are here, they tell you about how much money they can make from the ecosystem, which is not the purpose. Okay, so a few more statistics from the World Bank. So you can see from Ghana, you can see from these statistics, you can see. Not working? Yeah. Okay. Okay, let me go back. So you can see Ghana on the left side. About 60% of adults have an account, and roughly 45% thereabout have either made or received money, through the digital payment platform. You can see the figures for the females as well, and I deliberately have selected from almost all the continents. And you can see that in Africa, Kenya is leading, with around 80% of financial inclusion. And if you go to Europe, you see the UK and Germany are almost at 100% when it comes to owning accounts. But they do not have any mobile payment agents at all. You can see from the second graph. Okay, you can see there are no mobile, but all of them have gone digital. So while we are still discussing financial inclusion, is it possible that it can be achieved in ways that can be less expensive for the users? Because I know that with all these mobile payment agents scattered around, which is how Kenya did it, it's expensive for the users. So how are we going to be able to cut out that to make sure that people are able to do transactions at a cheaper cost? So moving on, I'll skip some of the slides. Now, this is a very important slide. Now, this slide, in recent times, when we talk about financial inclusion, we almost forget that it's about making money available for people to use to create wealth. We almost forget that. Now, if you look at this slide, it shows that in advanced countries, we have a lot of people are able to have access to credit. Okay, so firms with credit, more than 50%. In developing countries, about just 35%, and then in sub-Saharan Africa, very low, around 20%. Now, move to the next graph. You can see that in sub-Saharan Africa, the reason why people are not able to have, one of the main reasons is that we ask for high collateral. More than 40% of the loan amount is what we are asking for to give out loans. So people are not able to access. Now, is it possible that through financial inclusion, we are able to reduce the risk of lending so that less collateral is being requested for? Is it possible? Let's think about it. Okay. Now, and look at the interest rate as well. The people who are so poor are the ones paying the highest interest, which is unfair. So if you want to do financial inclusion, make sure you have the muscles to raise lower cost of funds and serve them. Okay, so I'll skip this slide, but a few words. Financial inclusion must look at the cost, as I said. And here we are looking at health insurance and life insurance. In Ghana, these are figures I picked from the internet. About 10.2 million Ghanaians, as at 2014, were in the national health insurance. The slide on the other side is looking at the situation in Europe, okay, where you can see that even over there, about 12% of adults are not insured when it comes to health. And these are the things that we should be concerned about. Now, the cost, you can see that, sorry if anybody from MTN is here, but you can see that rate cuts, reducing rates of transaction is seen as a Christmas bonanza, which I think is something that it should come to us easily. And the other example is from Kenya. Okay, so this slide is showing that we are so proud of the volume of transactions. The lower graph, you can see that, this is from Bank of Ghana. The volume of transactions has now hit 70 billion, and we are happy about that. But who is benefiting from this? Is a question. Who is benefiting from that? Is it you and I, or is it the fintechs, or is it the banks? Who is really benefiting from this? We have to ask that question. And for me, this is not financial inclusion. Okay, so this is just to show you that the players in the space, the number is increasing. There are more and more players in the space. Everybody trying to take a bit of the cake. Okay, so that increases the cost for the users. Okay, so now coming to the end of my presentation, this slide shows that there's still more and more money coming to every part of the world, almost all parts of the world, for financial inclusion. This is from the World Bank. It shows that in Africa, in 2017 alone, 4.8 billion. Okay, and the question is, what has that money been used for? Okay, so this slide is showing that, yes, indeed, from the 2000s till now, we've had poverty levels going down, and the people not in poverty, in extreme poverty, is increasing. We can see that from the green side. But how much of that did we contribute? From the research, this is largely contributed by access to loans, lower cost of insurance, and so on. Okay, so now the summary. Okay, so we are saying that financial inclusion is a new terminology for impact financial services. Okay, let's remember that. And that access to accounts and financial transactions is only a means to an end. Okay, the real goals, as I've said in my presentation, are access to loans, individuals and businesses, ability to generate surpluses and save, lower cost of transactions, innovative products to make life and health insurance affordable, ability to pay for education, ability to pay for food and shelter. This should be the ultimate goals. And the end result must be that we reduce poverty and increase the middle income. Now, technology is good, is a way to go, but there are two things that we have to check. Fraud, moral hazard, and asymmetric information. So, assuming you want to, you are a fintech, you are working with a bank to lend money, okay? Now, the only thing standing in your way is that you are not able to determine, whether the person is credit worthy. Are we together? You are not able to determine that. And you are not able to determine what the person will use the money for. Okay, and probably the person is a fraudster. And I know recently some people have borrowed money from MTN platform and they throw their chip away. You can't find them, yeah? So people may want to support individuals and businesses using technology, but because of asymmetric information, they cannot. So that's one risk. The second risk is the possibility of exploitation of the poor, which is what happens in reality, where all of us are making money from their little transactions they do, and we have to check that. And we think that the solution, I'm proposing 4 solutions. The first one is an effective national identification system. Okay, so if you go to, I showed you the earlier slide, if you go to Europe and elsewhere where people can just borrow based on their credit scoring, it's because they cannot borrow and run away. The identification system is so strong that anywhere you go, you can be found out. The second is the address system. From my own experience, sometimes you lend to small businesses. The next time you go there, they have left. They've gone to, they relocated. So that must be fixed as well for us to reach the goal. The third one is effective border controls. I remember about 8 years ago, I had some experience around Techiman, where we were doing loans to small businesses, and some of them just, crossed the border somewhere, and they went to another country. So effective border controls will help. And then finally, I believe the proper screening, and which I think is the most important, the screening of financial institutions and fintechs. I believe there are a lot of players, most of us sitting here, coming into the space for the wrong reasons. We must not be in there to exploit. So the regulators must check who is coming in. Thank you.